So basically what we wanted to do today was to talk about life insurance or life assurance. The reason for that is on the back of an ECJ case that was heard last year. That was in February 2013. And effectively what it's meant is that it's sort of placed life in the premium tax market, whereas before insurance companies in their home markets didn't really have premium taxes to consider. Now with the new interpretation of occasional risk rules, now there is another aspect to consider. And really what we're going to do is to address that. And if you have any questions, then please ask, and hopefully it'll be a lot easier with just the few of us in the room here. Dan, could I ask you to circulate that?
Yeah.
I mean, please have a look at this document while we're talking. It's essentially our rate table in relation to long-term insurance. And what we've done is to look at the 15 countries where there are parafiscal taxes, IPT and parafiscal taxes that apply to long-term insurance. And essentially what we've done is to research the legislation, look at tax authority guidance, case law. We've spoken to the tax authorities. And effectively we've drafted these rate tables, we've spoken to the tax authorities. Most tax authorities have signed off on that, so we're comfortable with the information that's on there. Other tax authorities aren't particularly cooperative, and therefore we've just got to live and work in those conditions really. So the agenda today, we'll talk about insurance premium taxes very briefly. Long-term insurance business, the 9 classes long-term business, how do they affect premium taxes? What we'll be looking at individual premium taxes and their rates and such like. We'll talk about the ECJ case, which is very similar to Caverna, insofar as Caverna was a landmark in general insurance in terms of looking at the location of risk rules. It's not quite the same landmark, but it actually poses questions of life assurance to be compliant with regard to long-term insurance business. And what we'll be doing there is talking about what happened and the implications. We'll talk about the 15 countries. Do you, as a life insurer, have a premium tax liability? How do you price your premium from a commercial perspective, making sure that you're compliant, there's no interest penalty charges and such like. What we're going to do is look at the top part of the Dutch rate table. We'll put that on the screen, and what I'll do is I'll just talk you through our thinking and analysis there, so you have a better idea of where we're coming from as a company. And then we'll just be looking at some of the questions that tax authorities have asked our clients in the recent past, not so much with life insurance, but general insurance, which will apply to life insurance. It's just to give you a sense of the type of questioning there that you could expect during an audit. And then really the takeaways, what's next for any life insurance to be compliant.
So we start with the basics really, and this isn't necessarily, well it isn't particular to life insurance, what we're talking here. Premium taxes apply to life insurance and to non-life insurance, and often the rules are very similar if not the same. However, for many life insurers, the concept of premium taxes are quite a new one. So just to sort of give some context to what we're going to be talking about and some terminology, we're looking at essentially 2 types of taxes: insurance premium tax and parafiscal taxes or charges. Now, they tend to be transactional, and that's what we focus on at FiscalReps, are the transactional taxes. The insurance premium tax is what is often the government levy, collected by the national tax authorities, goes into the general treasury. Just some example figures of what's being collected at the moment. UK revenue is £2.5 billion a year in premium taxes, and Italy at 22.5 billion euros a year. Probably reflected in the difference in the rates, 6% in the UK generally, and up to 22.25 in Italy. But they're not harmonised, these taxes across Europe, and with over 90 different taxes that are potentially applicable to insurance, that can create some real difficulties. Each tax potentially has a different rule about how things are filed, how things are calculated, when they're due. So in terms of building that document there, it's a very big job, and you can't take anything for granted. Just because it's that way in one country does not mean it's going to be the same in the next. So that's sort of the starting point when considering premium taxes, really.
And I think you can make a comparison to VAT if you're familiar with VAT. VAT is based on EU directives, whereas the premium tax regimes, the IPT and the parafiscal taxes, all, as Joe was saying, all have their own rules and legislation. What I thought would be a good idea here is to go back to basics. What do you mean by life? What do you mean by long-term business? Essentially, the two terms can be interused and can cause confusion. When tax authorities, tax managers, advisors use the term life, do they actually mean class 1, life and annuity, or do they mean all 9 classes of long-term business? To give you an example, I was in Greece last month talking to the Bank of Greece with regard to the PLIGF. And when you look at the legislation, you'll see the term classes used. So do they mean just class 1 or class 9, or class 1 to 9? And they meant life in its generic sense. Whereas if you talk to other tax authorities, when they talk about life, they mean class 1. So it's just important to make that distinction before we move on. So we'll try and create some ground rules here, where if we talk about life, it's class 1. We're trying to remember this, I think. And when we talk about long-term business, it will be classes 1 to 9. The other thing that was interesting, when the life case arose, we started talking to the tax authorities. It was our natural assumption to make that the 9 classes of business here, which are documented in the EU Life Directive, are not necessarily written and understood in other countries. So, for example, permanent health is very much a UK and Irish product, but if you talk to the Belgian IPT office, they're not familiar with that, and that will have quite an important impact in terms of how the IPT treatment is made. So just to flag that up.
So how do these premium taxes, the various premium taxes, actually affect life? Well, as Paul said earlier, there's quite often been an assumption that life isn't taxed, and that's driven by being predominantly a domestic cover. You'll buy your life insurance from an insurer locally. You know, it's far less common on a cross-border basis. And then you go to some significant markets, the UK and Germany. Generally, there's no premium taxes on life. So, dealing with German and UK insurers, the issue of taxes on their premiums is not something they've ever thought about. However, if you go outside of the UK, looking at some specific taxes on life specifically, in Ireland there's a levy on life insurance assurance premiums, and in Greece a private life insurance guarantee fund, as well as in some territories the taxes which are applicable to non-life insurance are also applicable to life insurance. So the case itself, I've still not quite got my tongue around the case name. So there it is.
Give it a go, Eli.
No, it's fine. Essentially, the background to the case. A Dutch life insurer was selling life, and we mean class 1 life, insurance to a Dutch resident policyholder. In the Netherlands, that kind of insurance product is exempt from IPT. However, the Dutch resident decided to relocate to Belgium. And then the Belgian tax authorities therefore wanted to collect their tax, which they do apply to class 1 life. So the question posed really was, who does have the right to tax? And in this case, in the Netherlands there was no tax, but who does actually have the right to tax? And there was 2 interpretations of this, essentially trying to answer the question of where is the member state of commitment. when considering the location of risk, the directive refers to the member state of commitment. So the first interpretation, the one that had been held by the Dutch insurer, was the static interpretation, insofar as your premium taxes are due based on the location where the policyholder took out the policy at inception, which actually, when you look at the wording, member state of commitment, that's where you committed to it, yeah, okay, that seems fair enough. What the Belgian authorities were trying to argue was the dynamic interpretation, which said actually you've got to trace your policyholder and look at where the premium is paid. So each instalment you've got to consider where is that being paid, where is the policyholder located there. And interestingly, before the actual case was heard, the Advocate General's opinion was actually of the static interpretation. Their view was you stick with where it was first taken out. However, the case found the contrary and said that actually the dynamic interpretation should be applied. It was, I think, the first time that this particular Advocate General had ever been contradicted. So it was the first time their opinion had not been followed. So it was
100% record.
Yeah. The amount of tax at stake was €5,000. So all of this for €5,000. So then we have this question, where is the policyholder? And we're looking at the habitual residence here. Now this is one of the first unanswered questions, and there's many more to come as we'll look at later, but we have the potential here for some double taxation when we're considering habitual residence because of the different interpretation of that in different states. So in the UK, for example, you have to have been resident there here for 12 months to be habitually resident. Spain only requires 6 months. So you can have these overlap periods where you could potentially have double taxation now.
So what are the implications of the case? Well, for a start, there are many unanswered questions. Like a lot of cases, it answers one question, but it poses 5 other questions, which isn't particularly helpful for the life insurance sector here. So first of all, as Joe was saying, that life insurers are just generally used to looking at their own premium tax regime here. They're not used to looking overseas. And as a result of that, they need to think about the reporting capabilities of their systems and processes to find the correct information. So for example, if a policyholder does relocate to another country, does the tax reporting systems pick up on that? If it does, that's great. If it doesn't, then it could be a manual exercise to try and locate, to mine that information in order that life insurance company that has the correct information to hand. There's also the case that when pricing a premium, the life insurer needs to understand what the premium tax rates are in the various different countries. Now that could be difficult because if you've taken out a contract in, let's say, Holland, if we follow the scenario of the case here, where there's an IPT exempt regime with regard to Class 1 business, then how do you price that into the annual renewals going forward? You're going to have to make changes to the terms and conditions. It's going to make it very cumbersome and difficult. If you don't do that, if you're not pricing in the premiums, we'll have a look at some of the rates later on, some of them quite high, then effectively you could be eroding your profit margin with any potential interest and penalty charges that could arise here. So as a result of this case, it's been an increase in administrative burden of the insurance company. Really the static approach would have been far more helpful to the insurance community. That hasn't been the case at all. And now we find ourselves in a very uncomfortable position. The insurance community is very highly regulated. It looks to meet all the corporate governance obligations, but here we may have a situation where there could be a Portuguese premium tax exposure, where let's say 50 policyholders have relocated across to Portugal, bought their holiday or retirement homes over there. Do they go through the cost of registering, appointing a fiscal rep, and then paying a very small amount of premium tax to meet the corporate governance obligations, or do they take a commercial decision not to be compliant, deliberately not compliant? So that's an internal decision for life insurance to take. It's a rather uncomfortable one this day and age, really.
So as I said, there's a number of questions that the ECJ did not address. And these are a few that we've sort of picked up on so far, but I'm sure as this develops and people start reacting to it and start processing all of this, there will be more questions coming. But just the four that we're sort of focusing on at the moment. Firstly, does the ECJ case cover all 9 long-term classes of business? The case itself was looking, as I said, as this class 1 life, but is there then the read across to all other 8 classes? And as I say, these are questions that are not addressed and not answered, so I'm just posing the questions at the moment. Where is the location of risk if an employer takes out a life policy on behalf of the employees who work overseas? Again, the case was looking to individual insurance, not looking at group insurance.
Incidentally, we spoke to the Belgian IPT authorities that are responsible for the ECJ case, and we asked them that very question. With regard to group policies, where do you consider to be the location of risk? Obviously, it's a big question for the community, insurance community. And they answered it was where the business was established. We thought with a dynamic interpretation they'd be looking at the individual insureds and where they were actually paying their premium as insured of that European or global contract. So that came as quite a surprise to us, actually.
Not to say that...
and sorry, if I may just comment, that was just one tax authority.
Yes, exactly.
Because another tax authority may take a dissimilar view. So it's no guarantee that's the right answer to a particular case. It's all down to how different tax authorities interpret that particular case.
And the granularity of it, if the parent is buying the insurance, and then the employees of the subsidiaries around Europe, well, again, a further question: where are the taxes due in that case? Next question: could the insurers be liable for taxes prior to the decision? Are we going to have some retrospective assessments being raised by the tax authorities, and then potentially, everybody's favourite words, penalties and interest? Is that potentially out there? And then also, could double taxation arise? As we've said, these differing opinions from tax offices. Are we going to find ourselves having to pay tax twice?
Again, we went to the Belgian IPT authorities about that third question there. In Belgium, could there be a liability before the 21st of February 2013? The Belgian IPT authorities took the view that it would be unfair to apply interest and penalty charges before that particular date, based on the fact that this is not a change in the legislation, it's simply an interpretation, new interpretation here as such. So do the life insurers have a premium tax liability? What I've done here is to list the 15 European countries. You'll see there are 2 non-EU countries there, Switzerland and Liechtenstein. And just to go through each one, you can see that in Austria and Belgium, we've got IPT, that's applicable to long-term insurance. When we look at the Dutch rate table, we'll see that there'll be exemptions available under certain circumstances. In Switzerland and Cyprus, we have a stamp duty. In Spain, we've got 2 consortia surcharges there, the winding up activity and the extraordinary risk direct damage. France, IPT applies, but only in specific circumstances. And then in Greece, we have 3 premium taxes that apply. Now, the PLIGF, strictly speaking, isn't a tax, it's a contribution, it's a guarantee fund as such. And again, when I spoke to the Bank of Greece, this contribution is not applicable if the insurance company in its home country has a guarantee fund that's similar to the PLIGF. So if you do have that, then the PLIGF is not applicable there. In Greece, we also have the IPT regime and also the TEAA-PAE. Now, Peter this morning gave it another name. That's a Greek acronym. This is the English acronym of the Greek name, if that makes any sense here. That's going to be abolished at the end of the year. So going forward, we're only looking at 2 premium taxes with effect from 1st of January 2015. Liechtenstein and Malta, we have stamp duty. I've missed out Ireland here. Ireland and Greece, as Joe said earlier, are the only two countries where they have a specific life tax. By life, I mean long term, rather than class one. Falling into my own trap. In Holland, IPT. In Portugal, 2 premium taxes. You can see there. Romania, there's still some work to be done there. The legislation provides us with enough information to say an operating fee is applicable, but we're not entirely sure, so we still need to research that. In Sweden, local insurers only need to pay the special tax on group life insurance premiums, and in Slovenia, IPT. And going back to what we were saying about this commercial decision that needs to be made, if there's a very small premium tax exposure, do you register, do you incur costs to be compliant? Just to reiterate the fact that if there is a tax liability in a particular country, there's no threshold limit. So it's not like VAT, for example. So if there's a taxable premium, there is a premium tax liability in that particular country.
So there are these taxes out there, but what sort of rates are we looking at? I mean, you've had a brief look at the table that we've built so far, but they're quite wide-ranging, and there's some which are potentially quite expensive. And as Paul was saying earlier, if it's not been priced into it, and then you suddenly, as a policyholder at the very least, your premium, you move to Austria and your premium suddenly goes up by 11%. Actually, as a policyholder, you're not going to say, blasted government, you're going to say, my insurer's just put my premiums up because I've that's going to be difficult for the insurers to sell and justify maybe. But equally, if they haven't taken account for them, it's probably going to be the insurer that's going to bear these costs. So have then lost that margin. That 11% is then being taken away from their premiums that they've been collecting. So Austria there is the highest one listed, but we've got various rates. Switzerland between 2.5 and 5%. Portugal between a very small 0.048% to 2%. In fact, that 2% in Portugal is the INEM, which is currently being, the Portuguese budget is currently being argued in the Portuguese government. Sounds like it's going to go up to 2.5%. Sounds like they won't agree on that until the new year, in which case they'll backdate it to the 1st of January. So we'll see what happens there. And then we've also got there Slovenia there with 6.5% rate.
But the most impressive rate of all that can apply to life is, or long-term insurance, is Holland, where we have the 21% rate. If I may, if I can just take you through how the rate table is structured here, and then I'd like to go through the different rates for the different type of classes of business and footnotes accordingly. So what we've done here on the left-hand side, second column, we have the tax code, and we've shown in this particular example the first 4 long-term classes of business. So you can see we have life and annuity, marriage and birth, linked long-term, permanent health. If we went down to 5, we've been taunting, which we don't see very often in the UK as such, but we found out the other day that in France it's quite an important insurance policy when it comes to mortgages and such like. The tax point is the date of maturity. What does that mean? Effectively, it's the date in the contract between the insurance company and the policyholder in respect of when that premium should be paid. In other words, it's very similar to a written premium date. The rate model is taxable premium. Again, be careful of that because it may include third-party administration fees if applicable, or it may not. You need to look at the individual legislations to ensure what they will be. And then we have the individual rates. So, as we found out from the IPT case, going back to last year, the Dutch insurance companies weren't applying any IPT on Class 1 life and annuity business. It was exempt. And the legal reference behind that is Article 24(1)(a), and you can see the actual legislation there. What we've done on these rate tables is to provide a series of footnotes, either to confirm a point, or if there's an exception, or as is the case, it could be an exception to the exception. It's never quite always black and white, so we're just trying to provide the the certainty all the time. And incidentally, this rate table was signed off by the Dutch tax authorities, which was very helpful. So footnote 1 basically is stating that life insurance policies is exempt, and that may seem like stating that bleeding obvious, but that's just saying that it's life in respect of class 1 rather than the 9 long-term classes of business. Then if we go to marriage and birth, we'll see that there's a rate there of 21%, and the article that provides that is Article 23. Article 23. The footnote 2 is interesting here because these are one of the classes of insurance the Dutch don't recognise in their own country. They've never seen a marriage and birth type policy, and as such, it won't fall into what you would ordinarily deem to be the exemptions there, because it doesn't fall into the specific exemptions. By default, it will then come to be 21%. So that's how we see these unrecognised products, classes of business being worked in other countries. And then we come on to linked long-term business. So if a life policy is linked to a savings or an investment vehicle, then it'll become 21%. And Article 23 supports that. So if it's a standalone product, it's exempt. If it's linked to investments or savings, it becomes taxable. Then we come on to an exception, so we can see a subclass here with regard to linked long-term. And if the policyholder is purchasing insurance relating to a house, and it's the main home, not the second home, or if you're lucky the third home, but the main home, an exemption applies. And this is where, for us, the real value is working closely with the tax authorities. You'll not find that in the guidance, and you won't find it in the legislation either. It was only through a series of telephone calls where we're talking this through that we found that exemption there. So it's important when putting these rate tables together to get that close cooperation of the tax authorities. The footnote 3 that supports that subclass, I'll just read this out. It says the tax authorities advise that insurance linked to life insurance in the purchase of the first home is exempt. Otherwise, if the insurance linked to the second home and or any other saving investment vehicle 21% applies. The insurance must be linked to the purchase of a house in order for the exemption to apply. So in other words, if you're taking out property insurance in relation to offices or warehouses, factories, you won't find an exemption there. Not that I'm quite sure how an individual would be linked in with an office or anything like that, but you can see the point I'm trying to make there. So that's essentially how those rate tables there work, and as I say, they've been signed off by the tax authority.
So we now got these life assurers having to maybe wake up to premium taxes that they've not had to do before. So the question of governance arises, and questions have been posed to the life assurance companies that they've and the maybe the senior accounting officers, the board, that they've not had to answer before, they've not had to consider before. So first question, is there a bit, and I believe this is sort of based on.
Yes, exactly right. These are questions that effectively we've consolidated from audits that have taken place with regard to our clients, and essentially what we've done is just poured out a few of those questions to demonstrate that if a life insurance company isn't compliant in a certain country and there is an audit, these are the type of questions you need to consider internally in order to support your position in front of the tax authorities.
And so these sort of questions we're looking at is, you know, if there is a business owner who has day-to-day responsibility for IPT, well then you're probably quite a long way down the road to having everything sorted out. But there's still the questions: who is it, and how do they see their role? What are the terms of reference regarding their role, and identified areas of accountability? Do they know where the records are kept? Have they documented their processes? Is it, you know, clearly demonstrable to a tax officer and also auditors and their internal audit function that this is all in place and that these taxes are correctly being accounted for? Also, what do they do to satisfy themselves that any associated tax risk is being effectively managed. What processes are there, what controls are there in place to make sure that all of their tax liabilities are being discharged or even identified? How do we know that we have, the correct taxes being applied to our policyholders that have emigrated to Spain? How do we know that that's then those liabilities are then being discharged and discharged in the correct manner? If there is no business owner, then the question is why not? And who then is in charge of it? So if you're answering no, you probably need to very quickly think about how you can start answering that question as yes, to put in these controls and satisfy these sort of requirements. I mean, in the UK we have the senior accounting officer requirements, and this fits in quite closely with that, albeit in the UK it's only looking at the UK tax position, and UK tax is exempt for life insurance, but the point still remains there are similar provisions in other European countries. Yeah.
So really, like any other audit, if the taxpayer can demonstrate there are records in place to support decision-making processes, if they can demonstrate that individuals have sufficient training and knowledge, if IT systems are hard-coded to show that premium taxes do apply to premiums that are written by the underwriters, this is all very helpful when supporting a position against a tax authority. So the last slide, I think we're on time, so that's good. Really the takeaways for yourselves, and that is, do you have a home or overseas exposure? And the question is, if yes, you do have an overseas exposure, are you going to go through the process of being registered? Again, bearing in mind that commercial decision that life insurance companies will need to make if the amounts are small in particular countries. We saw with Portugal, the rates are very insignificant, but in Holland, they're very significant. So that decision needs to be decided internally, commercials and the corporate governance. If we are registered, then you need to understand the processing requirements here. How often do you need to file returns? How often do you need to make payments? And then you need all the bank account details, etc., etc. From a commercial point of view, quite critically, you need to build in, let's say, 21% into the premium to ensure that profit isn't eroded as a result of potential interest or penalty charges as a result of the future audit. And the other two questions, which you've covered off anyway, are you compliant with regard to your overseas business? And you may not even know if you have any overseas business until you start looking at those reporting systems to identify whether or not any of your individual policyholders have relocated. And then lastly, in the event of an audit, and to be totally honest, we're not aware of a life in the sense of a long-term audit. We're not aware of one as such, but we are aware that the life insurance market is catching up with its compliance obligations, and I would say the tax authorities won't be too far behind either. So it's very much trying to stay ahead of the curve with regard to compliance here. So that's really what we wanted to bring to you as a way of an update of the position in Europe, in the EU in particular, although we've shown Swiss and Liechtenstein stamp duty too. Are there any questions on your part? I don't feel obliged to ask any questions because
Well, one, just clarification really. The Dutch position with regard to endowment policies, what we would call endowment policies, right, linked to investments.
yes. So if I just go back,
So if that endowment isn't linked to a residential property, it's subject to 21% IPT.
well,
That must kill that market, don't it?
exactly right. So life annuity, standalone, exempt. If it's linked, 21%. If you can show it's linked to that first home, you get the exemption. So it's zigzagging through there, that decision-making process to arrive at that final decision.
So if it's purely term life, there's no savings investment, it's
Be exempt, yeah. And that's what we saw in the IPT case last It's an interesting situation. It's a rather unsatisfactory position because nobody wants to be here. No one wants all the extra work or having to price in premiums like this in any way. And to be perfectly frank, this has caught the tax authorities on the hop as well, because when we've spoken to them, they really, a number of tax authorities didn't even know the ECJ case had been heard. So it's very much a case of everybody reassessing their position, and I would suggest maybe in 2 or 3 years' time, we could be having a different discussion around the table once everybody has caught up with that particular case. It's not too dissimilar from the Caverna case with regard to general insurance, where general insurance companies had to wake up to the fact that overseas premium tax exposure. You know, you go back to the late 90s, UK insurance companies were charging whatever it was then, 4% IPT on European policies on the total premium without having to apportion that and look at the overseas premium taxes. We've got a diluted form here in the RBS case insofar as we're looking at individual policyholders that are relocating, so it's very much a smaller aspect to Caverna, but it's similar in many ways. There's some themes there. Lovely. Well, thank you very much.